So how we can apply now a finance-based approach to company analysis to be involved into the growth strategies analysis? Let's move forward. We can now use a set of different matrices. And that matrix, which is now presented in that slide, belongs to the A.T. Kearney consultancy company, which is really well known in the world of global consultancy, I mean strategic consultancy firstly, as a company which is really focused on the growth strategies in different countries, continents, industries, and types of businesses. And now I'm presenting the first matrix, which I call here baseline or base metrics for our discussion. You see here on the vertical axis of that matrix, the sales growth rate, which is a strategic parameter, strategic variable showing how aggressive is the company in its product markets, in its product segments when competing with the rivals. On the horizontal axis, we may see the value, market value of companies' capital, the market value of that business growth rate. Both growth rates would be computed on a sample of companies from different industries, or you may just use this matrix only for one particular industry. A.T. Kearney Consultants applied it, of course, for really big sample of companies, which was 20,000 of different firms in many industries from different countries. So in case you are building that matrix, if you apply it to the multi-industrial sample or just to one industry, it doesn't matter. You have to compute the geometric means for the sales growth rate as well as for the market value growth rate. Then you will get these 4 different quadrants, 4 different segments in that particular matrix. And the first quadrant, Q1 here, means that there could be found the companies, the firms that can pursue so-called balanced type of their growth strategies because they are really very well performing in terms of the sales growth rate above average in that sample, as well as in terms of their market value. So they are really very attractive for their clients in the product markets on one side, and really are very attractive to the investments in the capital markets on the other side. How about the Q2? The second quadrant says that now we've got some companies here that are still very attractive in the capital markets for the outside investors, but they are losing some aggressiveness in their growth. They are now not among the top performers in terms of the sales growth dynamics. They are a little bit on the bottom in terms of the sales growth rates. And that's why we can call them focused. They are focused on the growth rate of their accounting profits. And we'll be back in a few minutes to this Q2 because it's not as simplistic as it looks like. The quadrant 3, which is Q3 here, includes the companies which could be called aggressive companies in terms of their very high dynamic in their product markets. They are expanding really fast and they are trying to compete and trying to attract as many consumers as possible from different industries, different consumer segments, so on. And many of those are competing geographically and internationally, cross-border competition. So they will get these new clients, whatever they can, and then that's why the growth rate would be much higher than the average that we've got here when computing geometric means. And the Q4, as always, in these types of metrics analysis are the companies which are in the bottom. They are lagging, they are behind in both senses, in both types of dimensions in terms of their product market, they are losing customers. And in terms of the position in the capital market, they are not as much attractive for the investors. So let's go forward. According to A.T. Kearney, applied research that I already mentioned was made on a really big sample of the companies for at least 10 years period. When they build that metrics like on average data for the overall period, and then they try to follow year by year on the yearly basis how the companies are changing their positions within this metrics, how they are moving across these quadrants of the metrics. And from that applied research on this big data, you may see several lessons learned. I'm just mentioning only a few of these interesting lessons. If we now just focus on the Q1, and if we will consider all the companies which are in this baseline metrics for across all 10 years or the overall period of observation as being 100% of companies just from this Q1, the first question is how many companies in percentage terms changed their position, and if they did it, if they changed their quadrant within this 10 years somehow, what were the main trends? So the first type of question and the first type of answer says approximately a little bit more than 50% of the companies from the Q1 moved to the Q3. So they lost some dynamics in the growth rate of market values in the capital market because they tried to be focused on the aggressive dynamic in their product markets, competing and being under pressure of some competition challenges, of some technological new trends, new products that the competitors introduced within these 10 years to the market on the yearly basis. When you are trying to react to all these changes, those companies which were first in the Q1, they made a decision that they are trying to keep very high growth rates in terms of their sales revenue, but it means that they were pursuing aggressive, risky strategies, trying to expand in several markets, trying to introduce new products, maybe in new markets as well for the new types of the clients as well. So it means their business risk has changed. It means their financial risk may also change because they will need additional financing. They will need to restructure their financing policies. So whatever they did, we can make the conclusion that their risk level of the business increased, and the required rate of returns may also increase. And that's why when switching from Q1 to Q3, they lost some dynamics in their capital market in terms of the market value growth rate. Now it's below than the average in that particular sample. We also see that some portion of companies, namely about 40% of them, they moved from Q1 just to Q4, which is the worst position in terms of the quality of growth in that particular metrics. And that's also very remarkable because we can now compare the last but not the least trend that is shown here. I'm now talking about the switch to the Q2, which means that only very few companies from the metrics in the quadrant Q1, they really switched, they moved to the Q2. So they tried to keep the growth rate of their earnings higher than on average, but they lost the dynamics in their sales revenue, and they also tried to keep their market value growth rate untouched and still high. So we can see here the first very important lesson. Even those companies who were in the best quadrant, which is Q1, who got the best type of the growth, which is balanced, they didn't stay all 10 years here. And they moved somehow under the pressures of the competition, of course, but many of those returned back. And the majority of those, they didn't move from the Q1 to the Q2. And only 9 or 10% of those, they really got these sacrifices. So they just lost the sales revenue dynamics. The question number 2 and the solution number 2 is also here in that slide. How many years it took to the companies which moved from Q1 to different segments of this matrix to get back? So they got back. And now we see also a very interesting result. Those who switched from Q1 to Q3 and Q4 even, they got back within approximately a year and a half. But those who moved from Q1 to Q2, they got back twice longer, within 3 years. And that's really interesting. And that interesting event has been called by 80 Kearney consultants the profit trap. Why? They were focused, those companies who moved from Q1 to Q2, on the earnings rate of growth. But they were very slowly returning back to the best position in that matrix, even much slower than those who dropped from Q1 to Q4, the worst position in the matrix. What were the reasons behind? So the origins of the profit trap could be explained by the so-called lost culture of decisions about the growth. Why? Because if you are trying to focus on the rate of growth of your earnings, but not on the rate of growth of your revenues, you need to cut and substantially cut your costs, your expenses. Doing so, you must go forward and you must be involved into the second step, which will mean that to get the substantial cut of your expenses, you need to decrease your capital expenditures as well, and you need to get rid of some your investment projects. And going further, when trying to restructure your investing policy and just refuse from some of your investment projects ideas, you as a company will more likely cancel the most risky projects. But what does it mean? Those more risky projects, when everything is okay, they will provide you with the high payoffs, with the high additional incremental cash flows from this new assets introduced with these new risky projects. But if you're canceling them, you are losing the opportunity of sales growth, you're losing the opportunity to get a really high increase in your cash flows. Finally, of course, many companies, when trying to substantially cut their expenses, will meet the need to decrease their research and development programs because they are very uncertain and in most cases they are really very risky. That's why, to summarize all this, I think you will also do believe to the lesson that A.T. Kearney derived from that type of analysis. If you are facing main challenges in your competition, even being in the worst, in the best type of your growth, it's really very dangerous to be focused on the earnings growth instead of be focused on your revenue growth. Of course, there might be some very serious reasons that will just push you for this particular shift. But you need to be aware that the profit trap is really a trap, and it's really very hard to get back to the best type of growth, which has been described by the Q1 in the matrix before. And from that also follows that All these companies, they have very different challenges for the future when moving from one type of growth to another one. Those who are very aggressive in Q3, they must finally find how to focus their strategy on some particular types of products, markets, and technologies, because being in Q3, they are mostly likely very diversified. Those who are in the quadrant Q4, they need to restructure overall strategic vision, their mission, their ideas, how they can enter some dynamic markets with which products, technologies, working force, so on and so forth. So they need restructuring, deep restructuring of their product portfolio and of their strategies. And those who are now in Q2, this is focus type of growth on the profits, they need expansion. They need additional efforts and additional investments to underlie and to push forward their sales revenue to be more dynamic than they have them before.